let's go ahead. So today we're going to be talking about investing versus trading, or trading versus investing. So I find a lot of folks get these two things mixed up when they think about investing. What they're really thinking about is trading, and what do people think of when they're trading? This might be something that they're thinking about, or maybe something where they're on the computer looking at stocks and trying to guess or estimate or predict whether they're going to be going up and down. Now, for the most part, most trading in equities is done by people who are making a market. They are not trying to guess necessarily what is going on as far as in the markets in a macro level. They are just trying to figure out what's going on right now, trying to match up what they call the bid and the asks, so they can make a tiny profit. Well, they wouldn't make as much profit as possible, but to ensure that they're making a small profit in each of the trades that they make. So, the bid and ask is what they call the spread. You bid a certain amount and you're asking a certain amount. You ask for a certain amount when you are selling, and you are bidding a certain amount when you are trying to buy. So that information is given to the market, and these market makers are out there putting together trades. So if you have a brokerage company, and if you are investing, most of you do, at least investing in equities, most of you have that, then your brokerage company is probably doing this, making money off of you. It's one reason why they hold your stocks. That's why they have you hold it in their name, and then they are trading your stocks. They borrow from you, very briefly, sell it to somebody, buy it from somebody, and it just moves back and forth really fast. And handling this transaction is how they can make money, and that's kind of a fair thing. And because they can make money off of this, they can reduce the fees, other fees for you. So, but regardless, that's one of the ways that a trader makes money. Now, there are different kinds of traders. That's this institutional trading, market making. Now, you also have people who work for institutions that are actually out there buying and selling stocks for themselves, or for themselves, for their company, essentially an institutional trader for the company that they work for, or for the companies they're representing, not necessarily the company they work for. So what are they doing? They're buying stocks and selling stocks for a company. Now, that person could be called a trader, but not necessarily so. What I want you to make the distinction here, in your mind at least, is the difference in the different objectives. So generally speaking, a trader is someone who's looking for a short-term advantage. Like the spread between the bid and ask is a short-term advantage, right? It's just the information's out there. Someone's willing to buy it for this, someone's willing to sell it for that. There's a small difference, and because of that difference, you can make money. So, we're talking selling, millions of shares, and they're getting, a penny, a couple pennies per share, just to make, enough money. Now, you cannot do that at the individual level. You would have to go through some licensing and have a certain amount of funds, of course, to be able to do this. But, you can't do that initially, at least. So, well, that's essentially what trading is. Now, there's another level to trading, and that's someone like let's call it a Gordon Gecko type. Gordon Gecko from the famous Wall Street movie I think every movie comes from 1988, so I apologize if that's not the correct year. Oliver Stone, Gordon Gecko, who was else in the Martin Sheen, back when Martin Sheen was coming up, was one of his big movies. Not Martin Sheen. He was in that too, but it was actually not Martin Sheen, the son. what is Martin Sheen's son? Not Emilio Estevez. It should come to me. Winning, I think the winning guy. Charlie Sheen. Sorry about that. Charlie Sheen. I digress. So anyways, that's a different kind of trading, right? Those kind of traders, yes, I mean, they in the movie they all look like bad guys, right? But they're looking for advantages within the stock market, like imbalances. They're looking for, in the movie, what they're essentially looking for is information that other companies don't have, other investors or traders don't have about a company. Now, they went to the level of trying to get information illegally, but trading is trading. You're trying to make investments based upon the idea that you have better information or you are faster or whatever. But essentially, they're short-term trades. Now, investing is different. Investing is not that. Investing is not, I have this little piece of information. I heard through my hairstylist friend who cuts, the haircut of a CEO, that I should buy this particular stock or sell that particular stock. That is not investing. One, the legality of that is of some question. And two, that's not investing. Investing is trying to figure out, one, what you need, what you're looking for, what your plans are for your money. When you're going to need money, how much money do you really not need that you're willing to put aside and not touch for maybe a decade, maybe never. Maybe you're leaving it to your grandkids, or maybe you want to start a dynasty, a familial dynasty, or whatever. Maybe you want to give it all to charity when you die. That's, it's up to you what you do with all your money. But anyways, that's the kind of thoughts that you have when you're investing, especially for the long term. Sure, there's short-term investments, but generally speaking, when you're talking about equities are not things that expire. They don't have expiration dates, generally speaking. Now, yes, you have companies that are being bought out. They're being bought out all the time. And this is a different kind of investing. Yes, you can look at that and you can invest in those things. Generally speaking, though, when people are looking at that and thinking of buying or selling, they're doing more of a trade than they are investing. So when we're talking about equities, generally speaking, we're talking about long-term thinking when we're talking about investing. Generally speaking, that's a very simple thing to do. And what it does and what it gives you, this sort of perspective, is this long-term perspective. It gets you a little bit of margin for error, right? You can make a mistake. Let's say you're making a 1% mistake today. You're buying something that's overvalued by 1% today. And so, yes, in the long run, you lose 1%. Now, if you lose 1% today, that's a lot of money. But if you lose 1% today, but you wind up making 12%, so you only made 11%. Like, when will that 1% overvaluation be seen? If it's seen immediately while you're trading and you happen to be on the long side, which was when you're long something, that means you're buying it. When you're short something, it just means you're selling it or you've sold it. So we'll talk about that another time. So while I mentioned it, so short, when you're short something, now selling a stock means you're short it. Now, selling it beyond what you've owned means that you have shorted the stock. Now, there's some distinction there. So if you have, let's say you have 100 shares of IBM and you sell it, you're short IBM. You've decided you're short IBM, so you've sold it. Now, you don't hold a short position in IBM. You just felt it was time, that you had better opportunities elsewhere, even if that just means holding it in cash. So you sold it. Now you can hold a short position in IBM, which means that not only do you think IBM is not worth holding, that you think the prospects are such that it will go down. It will go down at a rate sufficient enough that, or go up slowly enough that you, so when you short IBM or whatever company you short, you get money for doing that, right? If IBM is trading at 100 and you have 100 shares, they will give you $10,000 for shorting it. Now you have an obligation to repay those IBM shares. Now, at this point, I would say almost it is never investing when you short a company in this fashion. I will say it was always trading, because there is you don't hold a short position for the long haul, right? You don't say, okay, I think that IBM will be a bad company forever. Now you may say IBM is going to go bankrupt, which I'm not saying that. I'm just using it as an example. But that's not something that you can say is going to happen 10 years from now, 20 years from now. That's not a long-term view. That's I hope it happens as quickly as possible view. So, in my estimation, a short position is never an investment. And so I don't recommend investors have short positions. It's, you can get caught. I mean, you can do your math. You can be right about everything, and somebody else can come along and be wrong, and that makes your position wrong. Let's go over it really quickly. Imagine you have a company, XYZ company. It's trading at 100, and you have sold short one share, right? You sold short one share. Your position is -1. So they gave you $100, and you owe somebody $100. You don't owe them $100. You owe them one share sometime in the future. Now, when they force you to pay for that is a different story. We can get into that. What we're talking about, is margins and things like that. And your brokerage will have rules about that. I mean, there's certainly the law also requires a certain amount of holdings. But anyways, you owe somebody one share. They gave you $100. You don't owe them $100. You owe them one share. So what does that mean? Well, let's say somebody came along and you did your math and you said, hey, there's no way XYZ is going to be in business in a year. So this is easy money. You're going to guarantee when that stock goes to zero because it went bankrupt, you're going to not only have the $100, you're not going to owe anybody anything because XYZ stock doesn't exist. Well, unfortunately, if somebody else comes around, sometimes they call it the bigger fool, the greater fool, and they say, I'm going to buy XYZ company for 120. Right? Now you are responsible for their decision in a way, right? You have to repay XY, you have to repay somebody at the $120 price. So you're going to owe somebody basically $120 to get that. You're going to have to go out into the market and pay $120 to repay that share. So you're going to lose $20. Like I said, you can be right about everything except somebody else coming along and deciding, no, I think it's undervalued at 100, I'm going to buy it. Look, there's a lot going on in every company in the world because there's people involved. And when there are people involved, people are complex. They do crazy things, right? I had a company I bought at, I want to say $3.50, somewhere around there, $4, or round it to $4. And I did my math and everything looked perfect. But there was a lawsuit out there. And the company would go bankrupt if the lawsuit turned out to be, if they lost the lawsuit, and they would be worth about $20 if they won the lawsuit. So those were kind of, were two choices. Now for me, it was a fairly easy thing to do, I bought the company because the math said, regardless, it was worth $20. I'm not $20. It was worth the $4, and then it had the upside, anyways. But there were people on the short side, right? They were selling the company for $4, and maybe they were legal experts and they decided that yes, this company was in violation and they should go bankrupt. But it didn't happen. They lost. The company won. Those people who short sold the company lost, and the company went from $4 to $20 in a matter of a decision from a court. So now they are repaying all those, short position with $20 stock versus $4 stock. And when that happens, what happens? Well, this happened to be a small company, so now there's a rush of people purchasing the stock. So that can drive the price even higher because they want to repurchase it, because they're trying, first of all, they have what they call margin calls, and this kind of happened with some companies in the last couple of years. What's that, GameStop? I think there was a couple of other ones where, companies had these huge short positions and they get margin calls because the price went up. They got whatever, they sold it at $2, and so they got their $2 a share, and because it's so thinly traded, a few buyers were able to force the price up. Because of that, what happens? Well, there's a margin call because you only have so much money in the bank, and now you owe the amount of shares times the current stock price. So now they dive into it and they have to buy it. So they've become their own worst enemies, right? Now they have to buy it back at this inflated rate, which, because of their position, the amount that they have to cover, it can be quite a lot in regards to the total amount trading for a company, which drives the stock price up. So, but in short, that's what the difference between trading and investing is. Investing is a very long look at your positions. It's in stocks, at least, right? Because you can have an investment in a CD that's in whatever, 3 months, 6 months, a month, 2 weeks. You can buy bonds that pay you dividends every quarter, every year, whatever. There's different terms and different lengths for investments. So you can have short-term investments, but trading is almost always short-term. And we can go over some interesting trades that occurred, interesting trades that I've seen, arbitrage opportunities. Those things exist, but they take a lot of work and a little bit of luck to want to be able to see it, to be able to go, oh, this is an arbitrage opportunity. That takes, a lot of work. So, but one thing I wanted to mention to you, the difference between investing and trading, and, investing, has this long history of results, of positive results. I think the S&P 500, if you look back the last 100 plus years, you're getting a compound rate of return of over 10% a year. When you're a trader, it's going to be based upon your skill as a trader. Yes, you can get lucky. Anybody can get lucky. But if you continue to trade, your ability to find arbitrage opportunities will be the only thing that stops you from losing everything. Those opportunities do exist. They exist. With that being said, they're not easy to find. So think about that. Think about, this little picture here. This is the way it used to be. It's not really run this way anymore. It's a whole bunch of people on computers yelling at the computers. When you're a trader, when you're doing these day trades and you're constantly trading, this is what it looks like. And this is kind of what it looks like, I think, in people's minds when they think they're traders. Like, this is the activity going on, especially when they don't know what they're doing. But when you're investing, that's not, you're looking at the long haul. These things are little blips along the way, especially if you have the right, mentality. If you've really, set your mentality correctly. Anyways, I've got to go. Thank you so much for watching.